Hello and welcome to Gold and Silver Assets. It's Sunday, the 30th of August 2020. I've had lots of requests to come up with a pseudonym, and so here goes. You can call me Diora. That's a name that has French origins and means golden. There you go. Moving on to the topic of today's show, gold's competitor. Here I'm referring to safe haven assets. A safe haven asset is defined as one that remains stable or increases in value when stock markets drop. Traditionally, gold and bonds have been labelled as safe haven assets. Before I get an ear bashing in the comments about how other things are actually also safe haven assets, these are the two assets that are large enough markets that have huge amounts of liquidity and so are accessible to large institutions. When we're talking about bonds, the lower the bond yield, the higher the price, and therefore the lower the perceived risk. And that makes this chart a little bit mind-bending to interpret. So in blue we have the bond yields, but remember price is going in the opposite direction, and so ideally we're going to have to invert the chart. Here is the chart with the bond yields on an inverted scale, so at least you get an idea of the direction of the movement. But remember, this isn't the same as bond price itself. The scale doesn't represent that. That's still the yield. In green is shown the chart for the S&P 500. And below we can see the correlation between the two. Up until around the year 2000 over here, we can see that both the stock market and the bond prices were generally positively correlated, which means that they're moving in generally the same direction. And it's only up until after the year 2000 that they mostly moved in opposite directions. As we can see here, they were negatively correlated. Looking at these big stock market moves, we had a big drop over here, and at that time bonds move upwards. And again, we had a big drop over here, and at that time bonds moved upwards. Hence, bonds were acting as a safe haven in that sense. For gold, the relationship is not so clear. Here, when the stock market dropped, gold actually rose, whereas with this stock market drop, gold initially plummeted, but then bounced back before the stock market bottomed. And looking at the correlations, you can see that it just keeps flipping between positive and negative. And so gold doesn't really seem to be acting as a safe haven in the way that we had defined it at the beginning. Comparing bonds to gold, if they both act as safe havens, then surely they should be positively correlated to each other. This chart suggests that it wasn't until around 2007 that that became the case and that started to occur. Let's talk about the yield on these two assets. Gold has a zero or negative yield. If you can store the physical gold yourself, then it has a zero yield. And if you can store it professionally, there is a fee to do so. It's either a fixed fee or a fixed percentage of the value of your holdings. Note that this percentage itself doesn't change with the gold price. The problem for a long time was that the gold price had pretty much flatlined in the early 1980s to the year 2000. And so capital gains were minimal or non-existent. And therefore the fees meant that holding gold just wasn't attractive. It was kind of seen more as a chaos insurance, and that was a time when there wasn't really any sign of chaos, and so very few people held it. Historically, negative yielding sovereign debt has never occurred up until 2012 to 2014. So it's a relatively new phenomenon. Effectively, bondholders are paying for the privilege of lending their hard-earned cash to the government. Globally, negative yielding debt recently hit a whopping $17 trillion. I'm in no doubt that that figure will increase further. Why would anyone in their right mind pay to invest in debt? Particularly if you saw last week's video looking at the budget in the context of a regular person. There are a few reasons why this is actually quite attractive to investors. Firstly, sovereign bonds are viewed as risk-free safe havens. They perform better than stocks in a market crash, and so the small negative yield is worth the price paid. Importantly, institutional investors such as pension funds and insurance companies don't actually have a choice. They are mandated to hold investment-grade bonds. Unlike with gold, the yield is directly linked to the price. Therefore, the higher the bond price, the more negative the yield, and therefore the cost of holding it is greater. But that doesn't seem to bother people, since the capital gains can offset the costs. Of course, with all the above, we're talking about nominal values. But as our group know all too well, it's purchasing power that really counts. Nominal values are an illusion when it comes to fiat currencies. Before the full fiat era, this chart shows that the purchasing power of gold oscillated above and below 1, and there wasn't a huge variation. However, after 1971, we saw large swings in the purchasing power, but note that it never actually went below 1 and has a general upwards trajectory. I therefore think that holding gold is a safe haven in terms of maintaining purchasing power. When it comes to bonds, it's a different story. In blue, shown here, is the 10-year Treasury yield, and the red line is the yield adjusted for inflation at the official inflation rates. So remember, take a look at my videos on inflation to show that this is actually an underestimate here. But we can see that when inflation hit in the 1970s, yields went up, which means that bond prices actually dropped. But also inflation meant that the real yields were actually negative. So the bondholders were actually losing on both counts. Yes, when yields do turn negative, there are lots of profits to be made. But will these fiat profits be keeping up with purchasing power? They may well do so for a while, but you need to be pretty smart to work out when that flips and it's not the case. When it comes to safe haven assets, I believe that bonds and golds are actually two different animals, and it depends on how you define safe haven. For me, it all comes down to purchasing power. As we've seen, negative yielding bonds already exist in various countries. But can it come to the USA and the world's reserve currency? And if so, what are the implications of that? Well, that's a whole different topic, and so I'm going to discuss that in next week's video. Next up, the market update. Since we're only one day away from the end of the month, I thought we'd start by taking a big picture view, looking at gold in US dollars on the monthly scale. So here's the chart going all the way back to 1980. And there are a few things to point out here, and some of these we have discussed before. So the first thing is that we seem to have this rounded pattern here. And we were thinking of whether we would get a handle, but we never did. We actually blasted through that previous high there. The other thing to note is where we are in terms of the RSI. And at the moment, we're almost as high as we've ever been. So the two previous highs were over here and over here. But note that when we hit those, you can see that that corresponds to these points over here, and price got knocked back. Now over here, it wasn't quite so severe as this one here. So, and if you look at the RSI also, because this was a small knockback, the RSI cooled off a lot less than it did over here. Just because the RSI is high, though, it doesn't mean it can't go higher. There is no rule that says that. But obviously, given this history, that does suggest that we do need it to cool off. Now, the RSI cooling off doesn't mean we're expecting a catastrophic drop down to here. That's not how it works. What I'm suggesting is that the RSI can cool off if we get a drop, and I'm thinking that we're going to retest roughly around here and at worst around here. So we're looking at if we look on the smaller timescales, I've shown you the band that we're looking at, and we'll look at that next. But the big picture view here is that this pattern suggests that we're looking at a target of way above what's shown on the chart here at around 2,500 or 2,600, that kind of magnitude. So when I'm talking about pullbacks and knockbacks, don't get me wrong. I'm not telling you that price is going to plummet and we're going to go sub 1,000. I don't believe that at all. The other thing to note is that price is not going to go straight up to that target that we're talking about. And even just to get to where we are, you can see that we've had this zigzagging pattern. Now, people can deal with this in different ways. And so some people may have bought down here and just forgotten about it. They don't care. They think it's going up and they don't care about all these ups and downs at all. And they just don't look at it and leave it. But of course, there are others who may have bought some here and then they've come into some extra cash. And so they're looking at other buy points. And so, it just depends on what your outlook is. There are other people who want to trade this and that can add to their stack even more. So every single one of you will have a different strategy. And so that's why YouTube channels like this don't actually give individual signals to individual people. This is a more general overview of where things I think are going, and it really does depend on what time scale and what your own individual strategy is regarding what this means to you. Okay, and having said that, let's have a closer look. And again, this is still on the monthly scale, so this is a close-up of this area over here, and we can see that we've got this candle here. You can see it's got a small body and long wicks on either side, and that basically is an indecision candle. So people are uncertain about where we're going to go from here. In contrast, the candle before, this was a very strong green candle and very decisive. So this suggests indecision to me. Now, this is actually an anonymous chart. I won't tell you what the stock is, but this is just to show you an example of how I think things may play out. So here again, we've got this rise, then we've got this rounding pattern here, similar to gold. And this was the previous high, and it didn't get challenged there at all. It just broke through there, and as price went up, then it got knocked back, and then you got a retest down here. And so the retest came to roughly the top lip of this cup, as it were. Normally, when we talk about cup and handle, normally we expect the handle to form below this lip here, so further down. So this is more of a kind of a retest. And as you can see, price just shot up after that. And I'm wondering if that's what we're going to get, because that helps clean up the technicals for gold and makes the way for a bigger upsurge, which I think we will get. This is just another example here. So this is a bit messy over here, but we can see the left lip over here. We've got this rounding pattern here. Now over here, as it got to the lip, it did actually get knocked back, but it bounced back up. So I wouldn't really say that that was a handle, because it kind of fits in with this rounding here. So that's still all part of that cup kind of pattern. And once it exceeded that high, you can see that it started to struggle and then came down, and again retested over here, which again is roughly where the kind of body of the candles are on the left lip there. So what I'm saying is that at some point in the coming weeks, don't be surprised if we do get a knockback and a retest down. I just can't tell you when exactly that's going to happen. Going back to gold priced in US dollars on the daily scale, and we drew this line about 3 or 4 weeks ago, and it's been great because it's really told us where the support is. So over here and over here, it retested that and bounced off of that. So that is a reliable trend line, I would say, and it's hit that trend line a number of times in the past. The formation that we're getting here is starting to look like a triangle, which tells us that we are going to get a strong move coming up. The problem is I can't tell you which direction that strong move is. The problem here is that we can't easily draw where the top of this triangle is going to be. If we had assumed it was joining from the tip to this line here, then I think we would have been wrong, because then that suggests this is a breakout. It doesn't really look like a breakout, and the price action doesn't really fit with that. So the next possibility is to join these two here. But again, that could still be wrong. It could be that the triangle is not quite as steep as that. And this is the problem with drawing these things prospectively. Retrospectively, it's really, really easy to see. But prospectively, I think we can pretty much be sure that this is the bottom of the triangle, but the top line isn't so clearly delineated. I think if we go above 2000, then I think we're on our way up, though. I think that's pretty safe to say. The other interesting thing to see here is that we've got a very clear flat line where the bodies of the candles are. So that could be another indication, and that's around the 1925 US dollar level. And so if we get a close below that, I would think it would be more likely that we break this lower trend line. As I've said before, if we do break this lower trend line, then the target's going to be in this zone over here. And there's not much to stop it getting to that zone, because we don't have anything really in the way of support over here. Of course, if it breaks out upwards, and again, I think if it does, it's going to be a strong move. I think we're looking at around 2170, that kind of level over there. But the problem with these things is that we don't know for certain which direction this is going to break out. We do get these smarty pants now and then in the comments section saying, oh, so it could go up or it could go down. That's a very simplistic way of looking at it. that makes the assumption that, you know, the charts are some kind of crystal ball and people don't know how to interpret crystal ball. That's not what the charts are at all. This isn't a game of precision. It's a game of probabilities and risk management. And so that's how it should be viewed. And the chart is only one part of the whole system that you're looking at. And, you know, to do a YouTube video for 15 minutes covering all of that and covering every individual person's needs is just impossible. Anyway, let's move on to looking at silver. So this is silver in US dollars on the monthly scale. And I'm pretty convinced that this was the bottoming formation and we broke out of that bottom at this point. I don't think we're going to come back down here and languish down there for years and years. I just don't think that's a possibility. I think that we are in a bull market and price is going to shoot up, and it wouldn't surprise me if we get back up to these levels, you know, by the end of the year. The problem is, of course, is it's not going to go directly up there. We've already had 1, 2, 3, 4, 5 green candles in a row. That's a lot. If we go back and look at this bull market here, there we just had 3. Here we've had 1, 2, 3, 4, 5 before we had a bit of a knockback. And then remember, it moved up afterwards. And so, you know, I think it's a bit unreasonable to expect to have, you know, all green candles coming up to here. That's just not going to happen. Of course, we want to know when that knockback is going to occur, because that could be a buying opportunity. And I think it would be a buying opportunity. I'm not thinking that this is going to turn bearish at any point anytime soon. And let's have a look at US dollars on the daily scale. And what we're working with here is this zone here, which again we drew a couple of weeks ago, and it seems to be respecting that zone pretty well. The lower level is at around $26, and it's just continued to bounce up and down off of that. We were talking about a possible triangle over here. But again, as I say, you know, if that was the case, then we would expect price to come back up to here. And it may still do that, I don't know. But it's just not looking, because we've got this, you know, up and down like this. It's just not looking like that was the case. So really, we're just moving in a sideways direction. What we're looking for here, if we get a break below 26, then I think there's further downside to go. If we see a break above just over $28, then yeah, I think price is just going to rocket up. And I think it'll be a pretty fast, big move, at least up to 32, 33, possibly further up. But then again, I think it would probably get knocked back at that point. If we drop, I don't expect it to stay low for long. Okay, so if it does drop below 26, be ready, because the bounces can be pretty fast. We're not going to have weeks and weeks of price languishing down here at all. In terms of possible low points, yeah, there is a little bit of support around 24. And I would say that this line here is much stronger support over there. So those are the kind of bounce points that I'd be looking at. Moving on to the miners. So this is the GDX on the monthly scale. So again, we're going to have a big picture look at this. And you can see this strong move that we had in the last few months. But look at this, the RSI got as strong as it has ever been, certainly in more than a decade. So that should ring some alarm bells here. The other thing is, again, and I'm seeing this even in individual miners, is that we've got this indecision candle here again, which suggests a little bit of wavering in sentiment. And looking at the GDX on the daily scale, we had drawn this upsloping trend line, which broke and it actually gapped down below it. It tried to recover, but again, it got rejected. But remember that we never did make a lower low. In order to confirm this as a downtrend, we need to go below this level here. So at the moment, again, it looks like some kind of consolidation. Possibly we could draw a line like this and a line like this, but it's still a bit early to say. If that is the triangle, then we've still got a little bit more toing and froing to go before we see a breakout. And again, we'd have to wait for that breakout to occur before we can be confident of further upside or downside. So those are the levels to be watching there. And this is the SILJ, so that's the junior silver miners. And again, this is actually an uptrend that didn't break, which is interesting. Just bounced off of it recently. And if we can stay above this trend line, that would look positive for silver miners. But this is the line that you want to be watching. If we see a break of that, then I'd be concerned of downside at that point. But until we see that, you have to assume that price will keep going up unless we see evidence to the contrary. And a break of that line is that evidence. That's it from me from this week. Don't forget to like and subscribe. And if you want some extra material, feel free to join our members section. If you look at the community tab, you can see some of the titles of the videos of the topics that we discuss. Anyway, all the best and see you next week. Bye.